Righto, buddy miners. Welcome to another bloody JD and GC Spectacular, brought to you by Axis Mining Technology, the trusted advisor for drill hole survey instrumentation and the best people to talk to on the phone about it, because there's a guru on the end of the line every single time.
Love your work, Axis.
That's it.
No, so this was a bit of a little pre-diggers amble that you two kindly did while I went to a golf day. Thank you very much, by the way. I was doing some DD out there. BD. Who we got?
So we've got Jon Hronsky here today, and we've also got Ahmed to help us navigate the conversation. Jon is a super switched on geoscientist, and Ahmed helped us kind of get through that more technical part of the conversation. I'd listened to Jon on a few podcasts he'd done in the past, and I thought the ideas he had were absolutely fascinating. This is a guy with a couple of decades at Western Mining, a few years in there at BHP, then he's been running his own bit. He's been teaching out of UWA for quite some time, and he's got a few different talking points that I find absolutely fascinating in and around our kind of home ground of talking about the funding of mining companies, getting exploration projects online, and we're going to talk through things like the
Search spaces.
That's one of his sort of big features about how companies go about exploration. He's got models, and a lot of it kind of ties in with what BHP Explore has kind of done, although this is a concept.
Aggregator model. Yep.
Exactly. He'd come up with this concept a good sort of decade ago now. So I think with that, we'll rip into it.
Righto, good stuff. Here we go.
All right, Money Miners, we've got a special chat here with we've got Jon Hronsky, Ahmad, Ali, a bit of a different lineup today, but we're pretty excited to get into this. Jon, you've spoken a lot in over your career about a topic that's sort of near and dear to our heart. But the way I want to kind of segue into this is that crossover between business and the science of exploration discovery. And you've spoken about 4 rules for exploration companies in the past, and that kind of leads us into talking about search spaces and the funding model for juniors out there. And I want to start by hearing about search spaces, these 4 rules that you have for exploration companies out there, and then kind of go from there.
Okay. Well, the first rule is decide what you're looking for, because you've got to focus on something that's going to make a difference to you as a business. And if you're BHP, that's one thing. If you're a junior, trying to break into the industry, that's another thing. So you have to consider the thresholds, you have to consider, the capital, you have to consider the risks that you can take. So, for example, if you're a BHP, you have to be looking for a very, very large deposit, something that can replace an Escondida or an Olympic Dam. So, we in life have this sort of risk-reward relationship. So if you want something that has a very, very high reward, you have to be taking a high risk. So if you're genuinely in the game to find one of those deposits, it influences your strategy. So that's the starting point. You've got to decide what you're looking for and what's going to make a difference. The second point is you have to identify a valid search space where that could be. It's no good saying, well, I want to find this giant deposit, but it has to be within 50 kilometres of my existing infrastructure and I don't want it to be too deep or whatever, because that may well be a search space that doesn't exist. So when we talk about the concept of search space, what we're really saying is the search space is the intersection between what we know geologically about what's going to control the location of a deposit in space and what we know about the economic environment and, critically, the history of every bit of exploration that's gone on before. Because if someone else has already sterilised that search space, it doesn't matter how smart your geology is, it doesn't matter how smart your detection technology is, we already know it's not there. It's in some ways exploration is a very Bayesian approach. You start off with, I don't know, and you collect more data, and each bit of new data, reinforces a story. Either it is prospective or it isn't prospective. And, of course, the big challenge with the search space idea is that we find our biggest deposits where we have the least data. Really, really important concept. Kind of an obvious concept, but I restate it now because in the era we currently live in, where we hear a lot of stuff about big data and AI. And the idea is, well, actually we've got lots of data. All we need to do is analyse it in a smart way and we'll find the deposits. I fundamentally disagree with, because we don't find deposits where we have a lot of data. We find deposits in volumes where we don't have any data or very, very limited data. So that's a search-based concept.
And I think, just to interject here, I think one of the other important things about search space is that they can change over time as well. Yeah, so lithium will be one, right, where people discovered, tin deposits before, but lithium was obviously not in vogue then, so no one actually did anything. So one of the things I think here is that, like to John's comment, that you often find these things where there's no data. Well, it has to be data that's relevant to what the problem you're trying to solve as well is. That they could be actually data-rich areas, but it's just that we haven't looked for the specific thing like lithium in that data set, and hence we might have overlooked it. So so the concept of search space is like, it's not just a physical space that you will kind of look for. It's also a philosophical kind of space, and like, well, like how do your ideas evolve over time? How does the technology change? Technology can have a fundamental effect on how you find things. The detection limit of a certain technique gets lower. All of a sudden, like you can review that data differently. So I often find that search space becomes this concept where people think it's physical. They go, like I'm going to go physically out to the edge of the world because no one's explored there. Well, actually, search spaces can exist in well-explored terrains as well. It's just that you have changed the parameters of what you're now looking for. Hence, you've opened up a new search space in that sense.
Yeah, no, 100%, Ahmad. Search space it's an abstract parameter space. I mean, I didn't want to become too technical about it, but there's a number of different parameters that will govern whether a search space exists. Including all the ones that you talked about. The commercial regime in a country is an important part of that search space. But just to pick up a point about different commodities. Actually, no, before I do that, 2 points about search space. One, the reason why we coined the term search space rather than the other concept of exploration maturity, which you often hear people talk about exploration maturity, is we felt like maturity seemed to relate to just how much work had gone on in a particular area. Mm-hmm. And if that work had not been effective for the particular search space that we were interested in, it was irrelevant. So, some textbook examples from the history of exploration in Western Australia. The Kambalda nickel deposit was discovered in January 1966. And up to that point, within the Yilgarn Craton of WA, no one knew anything about the presence of nickel. In fact, no one knew that these komatiite rocks could host nickel. And the world experts said, no, you don't find nickel in those rocks because you found nickel in places like Sudbury. So that created a new search space. Now, that result, that drill hole, was basically right in the middle of the Red Hill gold mining area. So it was right in the middle of almost on, some of those samples of nickel were first found on the dumps of old gold mines. And of course, the Kalgoorlie had been at that point for 70 years a major gold mining centre. But that reset the search space. And the most recent sort of reset of search space we've had has been the lithium boom. So, if we're in a world where we're looking for the traditional commodities of gold and copper, which have been the two most important ones we've explored for a long time, it's a pretty reasonable assumption globally to say that not many of these deposits are going to be sticking out of the ground with an obvious surface expression, right? This wasn't true of lithium 10 years ago because people hadn't focused on that. So you could still go to places like Pilangora and say, there's a big outcropping ridge of pegmatite.
That's right.
Okay, fantastic. Because the search space for lithium was much less mature than, say, the search space for gold. I mean, people have been looking for gold around the world for a very long time. So, most of the surface one of the things to understand about search space is the technologies we have for exploring things at the surface are vastly more effective and cost cheaper than technologies for exploring below the subsurface, even like only a few metres if it's concealed.
So this sort of concept, we're getting right into the geology here, but we come at it from an investment lens predominantly on the show here. Is this a concept you think is widely held in the geological community?
Look, I think increasingly so, and it is actually very relevant to investment because if we look at the the opportunities for investment in, say, the greenfields exploration space, to me, the valid search space criteria is a really important filter that would probably, in my opinion, separate about 20% of the companies that actually have a chance and 80% that probably don't. So going to an area where there might have been lots of sniffs of mineralisation, lots of drill holes, but no actual discovery, and going back to those areas without coming up with some new search-based concept is not going to be successful. But oftentimes, investors who don't see things through that lens will put money into those sort of opportunities, right? So I actually think that the search-based concept, well, I teach this course, Senior Exploration Management, and one of the things I say is the one concept that I'd like you to take away from this course, more than anything else, is the concept of the search space. Why? Because it's the central concept that links the scientific things that we do in this business with the business outcomes, with the commercial outcomes. If you don't understand search space, you really don't have the key central concept to understand how mineral exploration delivers value to investors.
And I think that concept about why it's important is maybe if you were investing in a consumer product or something like that, I think it's slightly different in that, you can always grow your consumer market in a different way. You can sell shoes, but you can sell clothes at the same time, or you can sell hats. There's always something that you can add. Whereas I think in mineral exploration, one of the key aspects of why search space are important is because they're kind of exhaustive. Like once someone has explored an area, it kind of gets removed. It's a non-renewable kind of, so once someone has found something there and they've mined it, that search space is effectively kind of dead now. Or in order to grow that search space, if you want to go deeper or something like that, there's an economic parameter that comes in. It's not going to be more expensive. It's going to be harder to find. As a search space matures, the easier things should be found first, and the harder things now will be the ones that you'll be looking for.
And there's a pretty startling fact, though, that flies in the face of that, which you said in a previous interview, John, that roughly 80% of money going into the ground is spent on depleted search spaces. Why is this still the case? Because
the perception of, I think it's an incorrect perception of risk, right? And let me just tell it from the perspective, if I'm some sort of executive in some large mining company and I can have a program where I'm going to go out into areas with no known mineralisation, and it might be several years before I can return a result, but that might be what I need to do to make the discovery this company needs. Or I can do joint ventures on half a dozen projects where there's quite a lot of known mineralisation, and I know that I'll be able to report every quarter, I've got this drill hole intersection and I've got this drill hole intersection. Which option is lower risk for me professionally and personally, right? And which option is lower risk or higher risk for the company? They're not the same. And
so we'll just hang on a minute there. We're talking about risk and reward. And there's one company that popped into my mind, and that's MMS, guys.
Well, in terms of risk reward, no risk, shitloads of reward.
That's it. They take the risk off your hands.
Yeah.
They are
the mining company.
Trusted mining contractor out there.
And JD, I think MMS are that good that they probably don't even have risk either.
I think you're right.
Yeah.
Absolutely. And you know what else stands out about MMS, guys? Bloody tailored service they do. They, you've got any problem, you just give Josh a buzz, he will sort it out for you. I mean, we're talking about mine site support, drill and blasting services, contract mining services, obviously. There's a few good examples out there. Just Josh, he'll talk you through them. Dry and wet hire, anything else you want.
And the technical support. Evaluate the pit. Mate, don't bloody try and figure out how to mine it yourself. Get the miners to figure it out for you. You're just moving dirt. So love your work, MMS. Get onto them. This is going to be how mining contracting is in the future. Pioneering.
Here we go.
Good work, MMS.
We better get back to you, Jan.
I think that the reality is that, particularly if you're going to fund exploration from the risk capital market with a fairly sort of volatile source of capital, you need to provide that excitement. The idea of you've given me your money and I'll report back to you in 2 years' time when I finish this program. Who invests in that, right?
That's right.
So that's sort of the tension that goes on, I think.
I mean, effectively, it's like, people will do what's expedient, either commercially or, from a point of view of releasing stuff to the market or investor. Then I think what would be the harder thing to do, which is exactly what John's kind of talking about. Like, it would be harder to go and say, we're going to raise money, and for 3 years, we probably won't release a single announcement. But after that, we'll know. People will go, I'm out of here.
Yeah, because there's a couple questions I wanted to ask about that, because there's the concept of the search space makes so much sense, right? It's so logical, but actually practically getting people and companies to do it is such another challenge, right? The business element comes in, people, there's a resistance against change. And I think the other thing, which was actually touched on in a great Livewire article earlier this week, about people are scared to go to risky jurisdictions, and it's often the pressure from the public markets and public money to, it's like, why should I go pursue this risky or good asset in a risky jurisdiction here when I can just do something safe and easy over here. And it sort of talked about how there's this particular article talked about how there's a tussle between, we need more copper, although there's copper over here, or it's too risky. So it's just like, how do you breach that, I guess?
I mean, I think one of the most overused terms in mineral exploration is risk, right? Because I think, like when everyone says risk, I always like to ask the question, like, what risk are you actually talking about here, right? Fundamentally, mineral exploration is not a risky business, right? Like financially risky, because you only lose the money you put in. So you know exactly how much you're going to lose at any point. But now, is there other risk in exploration? Yeah, there's technical risk. There could be jurisdictional risk because you're going in a new country and you don't know how to work there or anything like that.
It's career risk. That's the big one.
Yeah. And I think that's, like to your comment in that, like why people why people are pushed by investors to behave a certain way is because if overall the investment crowd maybe doesn't want to take the long-term risk of actually finding something, or because mineral exploration, in a lot of sense, in a new search space, is a learning kind of exercise. And so so our investors, how many investors are there that would fund companies to learn for a couple of years before they actually do it? I'm not sure there's a lot of them, right?
Absolutely, and what a good exploration company should do is explore a project and then say, you know what, it's not here, I'm moving on. Yeah. Market often, though, wants to see people persist. They say, well, you raise the money for, to do this, that's what you have to spend the money on, even to the point the ASX says, well, you basically got to show the first 2 years what you're going to spend the money on. So if you have a concept, you raise the money, and in 6 months you've done the work and gone, there's nothing there, technically you still have to spend.
That's right.
And so some of these things are perhaps well-intentioned but naive.
Yeah.
Look, the reality is that the beauty about exploration is you only ever have to commit funds up to a critical decision point. So if you manage that well, you can be very effective with your use of funds, and it has the advantage that, particularly if you're in a sort of larger mining company, is it is actually discretionary. You don't have to spend the money. And as opposed to doing a very large, $1 billion transaction, it either fails or it doesn't.
Yeah, that's
and the consequences of that. I think it's really important just on this. I totally agree with Ahmad. The concept of risk is used. It's a very overused word, and it's used in a number of different contexts. So there's probably about 10 definitions of risk that are used in the mining and mineral exploration industry, and they're all different. Yeah. But often people will have conversations not realising that I'm using definition risk 7 and they're using definition risk 3. So this is part of the problem.
And you can kind of manifest that, like say in a group, in a mineral exploration company, you might have someone that's operational, someone that's BD commercial, and someone that's a geologist. Now, they may all use the term risk, but in fact, they're actually all talking about completely different types of risk. So even in one conversation, people will just say, well, is it risky? From a geologist's point of view, they're asking a completely different question to what the commercial person might be asking.
So, let me just use one example to sort of illustrate that. Many people will say, greenfields exploration, is more risky than brownfields exploration as an axiom. No one debates it. But actually it's something that should be debated, because if you say I'm going to define risk as the probability of an economic return on my investment, there's quite a lot of evidence to say that's not the case. A few years ago, Mike Christie, who's the boss of exploration for First Quantum, just did a very simple study, looked at all the copper mines that had been found over a period of time and looked at whether they were greenfields discoveries or brownfields discoveries. And remember that probably 70 or 80% of the dollars went into brownfields, and found greenfields found by far away more copper, right?
Mm-hmm.
So
Wow.
is it more risky? Because people confuse risk with the probability of an individual opportunity being successful, whereas risk from an investment perspective is a portfolio level concept, right? Because you're not just targeting one greenfields project and continuing to do that forever. So that, and they often confuse the risk profile of high profile, very successful periods of brownfields exploration with the overall
That's
profile
right,
of the greenfields exploration industry. Yet we know that in most situations, periods of successful brownfields ultimately then replaced by periods of unsuccessful. Why? Because you're depleting the search space.
That flies massively, I think, in the face of a commonly held view that brownfields is how you yield better results. Why do you think that is the commonly held view?
There's a period of time where that really works. So if I've made a greenfields discovery in a new terrain, right, and I don't know much about it, it makes sense for a period of time to focus all my resources there and find all those additional deposits, because that's the sort of embedded option value really that relates to the original greenfields discovery. So what you're really doing is just optimizing the value of the original greenfields discovery, because when we make our first discovery, particularly in a new terrain, there's often a lot more to be found, and that's why there's a real value to making those discoveries. But at some point, what happens, and in most companies, in most situations, money continues to get spent beyond the point where it's best to stop spending it there and spend it somewhere else, right?
And does that sort of analysis take into account the fact that you have economic advantages from discovering copper or whatever you might be looking for, given the sort of latent infrastructure in and around?
Oh, absolutely. And that's so in the brownfields environment, for those reasons, your success threshold is a lot lower, right? But at the same time, what you are doing is ultimately only incrementally supporting that existing operation. So that's fine, but what you're not doing is investing in finding the next one.
Yeah. And to sort of beat this out, you've spoken about advanced projects with a bit of disdain, and you've highlighted two types of risk, high risk type projects and no hope projects. I loved how you sort of, put forth that concept. Can you kind of expound on that? Because it's a topic that comes up a lot on the show, and you see the headlines, advanced exploration project or, yada, 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 and money just continually gets sunk into it. People know about it and they think, oh, maybe in a slightly better environment because the commodity price has gone up, never mind the fact that inflation has ripped through and the margins.
Well, I think that's exactly right, Jonah. So, we have these projects, and it didn't make it before, but, now the commodity price is higher. So maybe now it's economic, but as you say, usually costs come up at the same time. But the other issue with those sort of projects is there's because the dominant dynamic of our industry is the price cycle, right? If you think about what typically happens, rising price cycle, we dust off this dormant project in junior company, blue sky mining, and then we go to the market, get everyone excited, the share price goes up, and then if we're really unlucky, if the shareholders are really unlucky, there's a decision to try and develop this thing, and so we bring all that capital in and we build the mine just in time for the price to crash and the down cycle.
But it's also, I think, one of the reasons why advanced projects get recycled is for the same thing, where it's easier to go to the market with a project that, has a defined resource or has a study or, and I think, that's kind of the argument that in that up part of the cycle, it's much easier to go to investors and go, hey, we've got an advanced project, meaning it's much further along the line. But in reality, like there's a reason why, like John calls them no hope projects. I call them stalled projects. There's a reason why that project has stalled along its development line is because it has some fundamental flaw which prevented it from becoming an economically viable opportunity. Now, that might be commodity price. That's okay. Like commodity price goes up, all of a sudden it becomes economic. That's totally okay. But other times there are some fundamental flaws in these projects which they haven't solved. And people go, well, like price is high, we're going to dust this thing off. And look, it's now advanced and it's on the development path. But it's not, because it has the exact same problems it had in the last cycle.
There's always a new cycle of investors to run through it, though.
Yeah,
anyway.
Well, and the other thing is the project often changes its name.
Yes, I was going to mention the company as well.
Because you kind of hope the next batch of young investors don't even remember. This is exciting.
And John, just linked into that as well, you talk a lot about behavioural psychology as well, that probably influences these biases companies and investors and that they have. What's your thoughts on that?
Well, I'm a big fan of the Kahneman work, the behavioural psychology, and it's a key part of what we teach in our senior exploration management course. But one of the things that Kahneman looks at is how people make decisions in the gain frame and in the loss frame, and they make decisions based on whether there is a high degree of certainty with the outcome and there's a risk that you won't get it, or there's really not much chance. And you see different behaviours. So in some of those quadrants, you see risk-seeking behaviour. So, people buy lottery tickets because not much chance, but also it doesn't cost much to play. And I think that's sort of the rationale between, investing in like junior companies or whatever. On the other hand, we also see this behaviour where it's a relatively high certainty loss frame. Mm-hmm. For example, a mine is running out of ore, and that's the only time management get interested in funding exploration. They should have been doing it for 20 years. But in the loss frame, people will end up taking bigger risks. But I do want to say something about behavioural psychology and this concept of the fact that we make decisions in life as humans that are not risk neutral, right? So a risk neutral decision would be, I've got, a 1% chance of getting $100 million is equivalent to a 100% chance of getting $1 million, right? Mm-hmm. So those are identical in a risk neutral perspective. But I think for most of us, if we were given that chance, I'd go, you know what, I'll take the $1 million and the 1% chance of getting $100 million, I'm going to leave behind. So we often risk discount, and one of the contexts that we risk discount in is when the actual probability, the value of something, which we can say the expected value is probability by what it might be high, but because that probability is actually low, like in an early stage exploration project, we discount it. So what we see is that early stage exploration projects are often, and this is the good ones, you've got to filter out the no hope ones, right? But the good ones are often valued at quite low values compared to what an EMV would say they should be, okay? So, and actually after discovery, they're often valued higher. But what that means is there's a very interesting, human psychology creates a very interesting arbitrage opportunity for investors in that if you have the wherewithal, if you've got the capital to be able to take the risk that a number of these things are going to fail, but ultimately you could be successful as a portfolio, you're going to always do better being on the left-hand side of that discovery hole, right? Yep. Because you're investing at a much cheaper price than on the other side.
And you could just play the odds game to some degree, right?
So that's the logic for why large companies with big balance sheets should in fact do that.
But this is I think an important point in that like at some point in low probability success rates, you have to play the odds at some point to succeed. Like you can't. You either have to pay the odds or you have to play a very long game, right? So you're taking the bets, but you're taking them over a long period of time. And I think like one of the the frustrations I think I see is that a lot of people in mineral exploration are actually doing the opposite, right? That they're taking very few bets, like one project, and they're putting all their hopes on that one project to kind of get to the line. But fundamentally, that project almost always has a low probability of success. Like that hasn't really changed in that sense. But it's just that their perception has changed about it because they think, and this is often a problem with, I guess, technical people in the industry, where they think that project is the one. They have that false hope, and that's okay. But commercially, that, or investment wise, that that's probably not going to pay out in the long run.
So there's this unease between the risk that companies outwardly express that they are going to take, that they want to take, whereas their approach is actually quite timid. This is something you've spoken about in the
Richard Taylor, who got the Nobel Prize for economics, I think it was in 2015. One of the things in his book he calls it bold targets, timid choices.
There's a company that comes to mind, guys, when we're talking about grand objectives, but not timid action. I'm talking about grand outcomes, and that is bloody Greenlands.
Grand is like sort of short for green lands.
I think, yeah.
In a way.
Mate, you're absolutely right.
One in the same.
Yeah, one in the same.
And these guys, you open up their website and they've got some of my favourite words on the whole planet. Turnkey solutions.
Oh, and the video. How good's the video?
They are phenomenal.
Fly over the friggin' dam, mate. Sensational.
Mate,
it just reeks of water.
These guys bloody do it all. Any water-related problem you've got, these guys will sort out. You want to de-water an open pit. You want to de-water an underground. You want to transfer water across your mine site. You want to line some ponds. You want to lay some pipes. These guys will do it for you.
Mate, they will even drink water and make you less dehydrated. Like, that is how good they are. Like, they are absolute water magicians.
God's work.
That's the best word. Absolute doing God's work. So, mate, cheers, Greenlands.
Go Greenlands.
Go Australia.
Hydration kings.
And let's go back to your episode.
Yeah. And can you expand on this in the context of major mining companies out there that have, not just the small one asset companies, but the majors out there that do have the ability to have, and they do have a portfolio of assets, they have the capital to pick and choose how they go about it. How would you sort of guide them or tweak their decision making if they came to you?
Well, once again, I get to the point I made a little bit earlier. I think it's understanding where you want to be on the risk-reward curve, right? So there is no such thing as a free lunch, right? We all know that. If you want a really big reward, and the discovery of a world-class ore deposit is a massive reward in terms of sort of the multiples and the uplift. But it goes without saying that the risk, and I define risk here in the sense of the probability of that occurring, is going to be relatively low, right? So if we think about this risk-reward curve, I would say that as a big company, work out what you need to be and then work out what that means in terms of risk. So if you're a BHP and your portfolio looks the same as, I don't know, an IGO or a company of a tenth the size, it's probably telling you there's a problem, right? But what I was getting to before, the challenge we have is what economists call a failure of agency, because at the end of the day, there is no entity called BHP who's making decisions based on what BHP needs to do. There's a whole lot of individuals making decisions based on, a range of factors, including what's rational to them. And I'm not just picking on BHP, but just because they're the largest mining company in the world, but that sort of logic.
And I think back to your question about why behavioral psychology or economics matters in this space is because so Kahneman and these guys have talked about a number of kind of heuristics that people use. And one of the ones I think, aside from the one that John's mentioning, is this thing called the availability bias, right? Which is that people will answer the question that they can instead of the one that they should. Right? And so when you ask, when you ask someone in BHP, you'd be like, what do you actually need to do to find a world-class asset? Well, the answer is that they have to take on the commensurate level of risk in order to go and do it. But the way they answer is by answering the question of what they can do. And they go, well, actually, we'll go look around our existing asset for another world class. But that's not that's not the question they need to be answering.
Can incentives overcome this?
They have to be longer term, and they also have to acknowledge that there is a component of luck in here with good work. So, it's like I said before, exploring a project that was a genuine concept and realising that we needed to stop and moving on, that's something that is actually behaviour that we do want to reward. Is it being rewarded?
And I think, the short answer to your question is yes, right? Because we know from the field of behavioral economics, that's how you change behavior by incentivizing. Yeah, so John mentioned Richard Thaler. He has also another thing called the dumb principle problem or the asymmetrical risk problem.
Yeah.
And so to your question about incentives, yes, they can overcome that because in Taylor's example, he kind of expressed that he was in a multi-conglomerate kind of media company and he asked the CEO and the CEO wanted to take a high level of risk. And then he asked all the managers that sat underneath and they didn't want to take any risk at all, right? And fundamentally it came down to that if you were a manager and you took that level of risk and it didn't pan out, you would probably lose your job.
Yeah, it's fascinating, right? Because the behavior you want to incentivize them for is to take the appropriate amount of risk, everything else staying constant.
Yeah, but then
doesn't mean they'll be at an individual level a successful outcome.
But the outcome of taking that risk can then not be career detrimental to them either, right? You can't have it both ways. You can't tell someone take a lot of risk, which is going to have a high degree of failure. But if you fail, I'm going to sack you.
Yeah.
That's not the right way to kind of.
So in that Taylor example, right? So the CEO wanted to take all these projects, and I think there was something like 10 executives, and each one of them was told, well, here's a project that if you invest $1 million, there's a 50% chance it's successful and you get $3 million, right? And a 50% chance you lose it all, right? And the CEO said, we should take all of those, and very, very few of the individuals wanted to because 50% is a pretty high probability, right? 1 in 2 that you're going to lose it. So, and that's this whole idea of risk discounting, because pretty obviously 50% probability that you're going to get 3 times your investment back is EMV positive scenario, right? So in a risk neutral world, we should take all EMV positive scenarios, but we don't because of risk, and risk is ultimately an individual thing, and it's ultimately a psychological decision.
So we don't just want to talk about the issues around there and the problems with exploration companies and what the industry faces at the moment. And, thankfully you've thought a lot about this, John, and you've put forward a really sort of succinct and interesting paper on this idea of an exploration aggregator. Mm-hmm. And I believe this was written sort of late 2010s, 2016.
Something like that. I think I spoke about it at PDAC in 2016. Yeah. So the basic idea there was actually to thinking through some of these challenges and feeling like as a global industry we did not efficiently allocate capital to this really important task, which has only become more important, of greenfields exploration, right, and finding these new mineral deposits.
And I think just to interject there, John, one of the fundamental things about the funding is to say, there's 2 schools of thought. One of them says that, we don't have enough funding. The other says that we actually have enough funding, is just allocated badly, to some degree. And I think, and I think that's an important point in your model, is that it's not advocating that we need massive amounts of increased investments. It's just that the investment we have could be better utilized
absolutely.
by the agents around.
We may need a bigger global quantum, but to do that, we need to demonstrate the results. Yep. And you can sit down and do the numbers where you kind of say, well, how many big deposits are being found each year, and they're all worth a certain amount. How much are we spending as an industry? And those numbers don't look that good. They're quite high. It's like probably of the order of $200 million US just for any type of deposit, not a tier 1, and it's probably something like $8 billion for like a tier 1. But the problem with all that sort of analysis is that a very large chunk of that money, the global exploration industry spends, it varies of course, but somewhere of the order of 10 to 15 billion US a year. Mm-hmm. And a very large part of that money is not focused on finding new tier 1 deposits. Exactly how large? I don't know. If I had to guess, I'd say probably close to 90%. Now, some of that's for good reason, in that the money's been allocated to, around existing operations and so on.
Yep.
Some of it for less good reason. It's being allocated because to projects where there is an opportunity to raise capital, or some of it is because there is an ecosystem in our industry, and below the level of tier ones, you can, there's viable companies finding smaller stuff, but that doesn't really solve sort of global problems, and it's not got that sort of tier one type value creation. So I guess my concept would be being selective, right? So part of the exploration aggregator model, the first point is that you need the skill set in the aggregator to make sure that the gating process is that the only thing that ever gets funded are those projects that have the genuine opportunity to find the tier one, right? So that's the first thing.
So you improve the odds essentially, right?
Oh, absolutely.
Like you're not spending money on things have no hope of ever getting anywhere.
So just to be very clear, you obviously want to apply your best science, and if you do that, some projects might be better than others. But the reality is that I'm not saying you can be too sophisticated at that early stage in saying, well, this one's maybe a 1% probability, this one's a 1.5% probability, or whatever it is. But what I'm saying is you want to cut out anything that's a 0% probability, right? So that's the key point. You want to reduce it to those things that have a genuine chance. That's the first filter. The second filter is it has to be managed as a portfolio, and you need that capital pool that there's this concept of gambler's ruin. So even if something is EMV positive, right, you might go broke before you get there. And your ability to avoid gambler's ruin is a function of your pool of capital. That's right. So you need a pool of capital to be able to manage this as a portfolio.
And your bet sizes, right?
That's right. Yeah, that's right. Yeah. And the absolutely critical thing about bet size is you've got to manage all your projects with decision point planning, right? So this is getting into not the micro, but a really fundamental concept. It's not like I've got this exploration project and I'm going to spend 20 million or 30 million on it. It's like I've got this exploration project. It could be the next Escondida, but after I've spent, 2 or 3 million doing these drill holes, I will know whether an Escondida is there or not. Now, if I'm unsuccessful, it still could be something small, but I know it's not the big one.
Yeah,
right?
That's right.
And
that's your decision to kind of walk, right?
That's right.
If you're not going to get that payoff, then you're not, committing funds just for the sake of, because that's the only project you have, or whatever other kind of metric that comes in.
And the sort of the third aspect, and why I call it the aggregator, is I think one of the things we learn from the history of the exploration industry is it's very hard to do things as a big sort of global conglomerate, because there is a real value in being close to the ground, close to the local people, close to the local geology. And, I remember a few years ago there was a study on gold exploration which showed the most successful explorers were the ones that were focused in a particular region. Makes a lot of sense, right? And the reason why it makes a lot of sense, and I'll come to this in a minute, is the learning curve, right? But how can you simultaneously have a big global portfolio but also have, let's call it local expertise, local skill set, local learning? Well, you've got to support a diversity of organisations. So, whatever this sort of overarching source of capital is, and I think the BHP Explore model is sort of one model globally which is kind of trying to do this at the moment, and it seeks high quality opportunities from all around the world. Whether it's got the critical mass it needs yet, I don't know, but I think it's a very good step in the right direction. But you need to be able to support a diversity of groups that have that local expertise, that local knowledge, so they can be effective. And then fundamentally, there needs to be a commercial framework which is win-win, right? So the larger corporation obviously ultimately wants continuity of its business by getting access to these things, but it has to be prepared to give enough away, because you think about why someone invests in a junior exploration company doing exploration. It's not for like a 50% return on their money, 100%. It's the small but non-zero probability of a very, very large return. So it's very important that that's not capped. So But just sorry on learning, because one of the things about exploration is that if you look at sort of average success rates, it doesn't look economic, right? But if you think about one of these curves of I'm going to explore 100 projects and it's going to cost me X and what's the MPV of my program, what those models imply is the probability of success of your 100th project is the same as your first project. And what that implies is that you haven't learned anything. And in real life, if we're doing exploration well, we're exploring an area, we're unsuccessful, but that information is fed back into the next set of targets we drill and the next set, and we improve that probability of success. So that the learning theme, that's the key. That's the key juice that drives this, and why, persisting in local areas or persisting around a particular commodity type is so critical.
And I think this is, like this last point about the learning curve is, I think when we look at companies that were really good explorers, that's, I think, one of the, like in the stuff that we did in our podcast, that's one of the themes that kind of comes out, is that actually they kept a group of people together for enough time so that the learning could kind of bounce around between them to a point. And that's kind of and it's not a nebulous concept. Like, if you think about sports teams, like the teams that are really good, they tend to have an organizational culture, or like their organization is set up a certain way where that learning feedback loop is kind of getting passed around. Like if they're drafting players, they learn from the mistakes that they've made, so they're not making the same dumb mistakes the same time again. Whereas organizations, like in sports organizations, are really easy to look at when they go through this period of, like the board is cleared out, or the executives are cleared out, the coach is sacked, all of that stuff. You can see that they don't have a great success rate in that. And you can think about, if you're a basketball fan, you think about the San Antonio Spurs or something like that, a massively successful organization for a long, long time. And they've basically kept the same people there for a large period. And that's kind of like the learning curve model, is that if you can keep them around without having to sack them every 3 or 4 years, then, that's kind of the critical mass you want to build.
I think the Chicago Bulls might be a slightly better example there as well. And you can sort of see there's a long teething period, and then eventually, the flywheel starts humming and you get championship after championship.
Right. And I think that, and then that's kind of the concept, is that, like exactly the point you made, is that there is a period of lean years, because you're still figuring it out. Like in a sports organization, you're figuring out your drafting strategy and all these things. And in mineral exploration, I think when you go into a new area, you're still figuring these things out, right? You're figuring out which areas you can really work in, the type of techniques that work best, like how effective you can be from a dollar point of view in exploring in certain areas. And so there's this, basically flatline kind of payoff period. But then when you get to that point, it's kind of like the Chicago Bulls model, is that the success comes really quickly after that, because you've now amalgamated all this
And if I can just sort of make one technical point about learning, the most important thing to learn is what is a false positive, right? Because mineral exploration, it's a low base rate environment, which means that the targets that we test very rarely have what we're looking for, which is an economic ore deposit. And simple, Bayesian probability tells you that in that environment, the key factor, if I'm looking at an anomaly and deciding whether it's associated with an ore body or not, is the false positive rate of that anomaly. In other words, how easy is it to create the same anomaly that's not an ore body? And that has some really important consequences. So I like to say that, when my daughter was 10, I taught her how to assess ASX releases for exploration companies. Very, very simple method. So go to the page where they have a plot of all their targets and count them up. And if there's more than 3, they're no good. And the reason is ore bodies are rare. So if we're going to say this is the signature I've got, a geochemical anomaly or a geophysical anomaly, it needs to really stand out to have a high probability. If we've got a lot of targets, by definition, and it's a fundamental output of Bayesian analysis, the targets are not very good. And yet you still get people saying, well, we've got lots and lots of targets. That's a good thing.
Particularly like geophysics, this is a classic one where they go, we've got 50 anomalies, and you go, I think you've missed the definition of anomaly.
Anomaly.
The heuristic I have is I like to say that green and yellow are not your friends. And by that I mean, if you've got your map and you're using a typical sort of spectral stretch, you want to have the big red and white dot on a blue background, then you've got a good anomaly. If you've got lots of green and yellow in that map.
Yeah, that's fine. One comment I wanted to make about Jon's, model about the aggregator, because, we kind of had this discussion a couple of times. And I think one of the fundamental things why you would want an aggregator model is if you start off with the premise that every dollar being spent in exploration is not the same, then you can see that there are people that are spending dollars effectively and there are people that are spending them ineffectively. And so, what you want to start off with, so if you start off with that as your premise, you can say that there are some agents, and Jon said 90%. Rick has his own the Rick rule has his own percentage of how many companies are lifestyle companies and not really wanting to find things, right? And so I think that's always the premise that when people say this, we take the total expend in mineral exploration worldwide, and we say this is the amount of metal that we found. The basic assumption you're making is that every dollar being spent is the same. Mm-hmm. Now, if you change that around to actually looking at companies that spent effective dollars and ineffective dollars, that rate of return would be much better.
100%. Right? Yeah.
And again, to my sports analogy, exactly the same, right? At the start of the season, you have X number of teams, but you know that there's only a handful that are legitimately going to be at the top of the table, and the others are just making kind of numbers up, right? Because they're not good enough.
Yeah.
And I think it's the same in mineral exploration.
Oh, I was just going to say, just sort of on that theme as well, do you think that the nature of the exploration sort of aggregator and the sort of behavioural economics that we sort of see and heuristics we sort of see, do you think it makes it sort of more suitable in a sort of private capital market as opposed to public?
Look, I think it
naturally
does. Yeah. I think there is a natural tendency for that to be so, yeah.
More like long-term patient capital, because it's just
right.
The public markets just, I don't think could cope with something like this, even though it makes more sense.
The public markets could invest in the aggregator in the same way people invest in sort of Berkshire Hathaway, for example, if it was successful, but they probably wouldn't do it until it had demonstrated some success. Yeah.
I think those investors are few and far between.
Yeah. But you can see, you can see that in, I guess, other industries, right? Like the VC world, there is very little involvement in kind of the startup world, the VC-driven startup world, from public entities, right? Like they're often, they never come in the early money, but they're happy to come in Series B, C, whatever after that. Yeah. But that I think that is a fundamental kind of constraint.
I want to just really tie this into a real world example, because you've put all this work in, but what we've seen since this paper come out is, like you say, BHP Explores program, and it is remarkable to me at every turn incentives are just in your face, and you highlight there that you need to incentivize the smaller company, whether that be the people. Everyone at every stage needs to be incentivized by the ultimate outcome. Now, BHP Explore has actually started to do this. They've had a couple schools now, or groups of
cohorts, I think they call them.
Cohorts, that's the one. And I mean, in your model, you put forward the example that it can be a major mining company, it could be a direct agent, it could be a specialist third party. Do you think a BHP is the best type of company to do this? And given that they've now put this into practice, where would you sort of guide them on improving what they've done?
Well, first of all, I think it's great that they're doing it, because I think they need to do it. And one of the reasons they need to do it is I actually don't think we have a globally successful model. And I've worked in large global companies who've tried to do global exploration. It's very difficult to do as one company. There's a lot of overheads. There's an increasing amount of internal friction that prevents that being done. So
just the level of organizational complexity you need to work in, Australia at the same time work in the high Andes. It's just not it's a complicated exercise.
So I don't think, and if you think about the history of our industry, when I started, unfortunately over 40 years ago now, but we didn't really have this concept of people exploring globally. There was only 4 or 5 countries in the Western world people would mostly explore in anyway. And if you're in Australia, you explored there. If you're in America, you explored there. And it was only really after the end of the Cold War and we had this big era of globalisation that we started to try and think about exploring globally. And I think at one point in the late 90s, BHP, for example, in 48 countries, right? And that's 48 officers, 48, groups of people. Now, that didn't last that long. Western Mining, we were in about 25. It's not really sustainable. And I just think it's too difficult with time zones, with, as Ahmad says, internal complexities, all the constraints, particularly around licence to operate issues and so on. So a model like Explore is probably what is required, but there's a few key aspects that are required to make that model work. One, you need really, really good, experienced technical people who are providing that filter, right? So, you need people who really have been in the industry for many this is an industry where it actually matters. Experience matters, the right sort of experience, but it actually is important. So it needs to be guided by that. Secondly, the commercial frameworks need to be such that people want to bring their best projects in, not just the projects they don't think could get funded in the risk capital market, right? So, to me, that's the test of a model like Explore. Are people bringing a project in because it's their core project, it's the one they really believe in, or are they bringing it in because it's not their core project, they're kind of interested in it, and they think this is an alternative avenue for funding? And that gets back to, and I'm not familiar with any of those sort of details of those commercial agreements, but fundamentally that gets back to that attractiveness. And of course, like everything in life, branding and marketing, right? So if you have successes and this is a successful model, and to be a successful model, it has to be successful for BHP and its shareholders, but also successful for individual companies within that. So by being part of the scheme, companies have to be at least not worse off, maybe a bit better off, just by being in it. And then, of course, not all of them are going to be successful, but if they are successful, they're going to have to be seen to have benefited significantly from that success, as opposed to the default alternative, which is raising capital on the risk capital market, the public markets, and so on.
I think to your question, whether it could be done most effectively in the major mining company or not. If you take the example out of mining into other industries, say like a VC that does it, accelerator program or something like that. I think the one fundamental difference is that the VC doesn't have a vested interest in the entity that's being produced by the startup or the product that's being produced by the startup. Whereas I think in BHP that's where I think you have to have a really sound commercial model, because BHP is kind of facilitating the accelerator program, call it whatever. But then at the end, they're also the customer that wants to kind of get, right? And I think
it's existential for them, isn't it? Really, ultimately, that this program is successful. That is a pretty important distinction.
So I think they have to navigate that internally, as well as the companies that are coming to them in a different way, I think, than a standard kind of accelerator model where VCs are just coming in as an investor, and then they want to help the company get somewhere. But they don't have a vested interest in that product or that outcome of that company.
I think that's a very good point.
So that, I think, is a challenge of how you do it internally. But to be honest, the best agents we currently have in the industry to do that, I think, are probably major mining companies.
Yeah. Well, I think they're the ones with the most skin in the game, right?
Yeah.
So if you analyse, and I've done this thought process of sort of analysing who cares, right? Ultimately, who cares that there's not efficient allocation of capital to global greenfields exploration?
Yeah. BHP does,
the biggest stakeholders are these large multi-generational mining companies, right?
And then that's just if in the space of exploration, if you're a major mining company and there's not an effective allocation of capital to make new discoveries, then at some point your business is going to struggle, because it's going to have to buy things at a higher and higher premium to add to your reserve base or your business base.
But at some point, there just won't be the assets that can generate the metal
correct
at a cost that makes sense. So I suppose, just thinking through that one step further, at some point it becomes a societal or a governmental issue. And of course, that's something that's changed in my career, because it's only been in the last half a decade or so that we've started to see a serious involvement at a global level in terms of governments and people thinking about minerals, because for most of my career,
that's a good point.
minerals and mining was to be honest looked down on and seen as somehow inferior to technology and all these other things.
Yeah.
And it's just something you took for granted. And now we know that we're in a world where we can't do that.
There's no interest like self-interest, right? These big companies get on it. There's this concept I read about, I hear about a lot of these companies from back in the day that were really technically focused, that had great cultures and everything, and Western Mining comes to mind, and there's a few others. Do you think this is a rose-tinted view on the past, or was there something distinctly different about how they operated?
I think, first of all, some of it is obviously, there is always those rose-tinted glasses, but I think there's some real substance to it. But I think you've also got to see it in context, right? So one of the things that Western Mining did, for example, a very concrete thing that I don't think any organisation does on the same scale today, is its study leave scheme.
Yeah.
So it would provide, and pretty much any talented geoscientist would get funded for half salary for a year to go and do a master's, and then in the end, I got funded to do a PhD, for example. I never would have been able to do it otherwise. So I was a beneficiary of that. So there was that very, very significant investment in development. It's one of the reasons why people used to talk about Western Mining as the university to the industry, because it did that. And it probably did that a lot more than other companies, but that was a more common thing.
But they held on to the people.
Yeah, correct. So there's a couple aspects about that. One, it was a world where the culture was more like, I've joined this company and I'll work for them for a long time to retirement.
Yeah.
Right? That was a different world to what we have today. But the flip side of it is, when you invest in your people, you're more likely to keep them anyway. So I do feel that it's interesting that companies today, which are, plus 10 times the sort of market cap of what Western Mining ever was, don't invest in this sort of training. I mean, if they do it very, very sporadically.
But one of their pillars is people is our biggest resource, John. But yeah,
I know.
And they're far more profitable than Western Mining.
Yeah. That's
I mean,
right.
I can only give my example. Like I remember going into, like my career corresponded with the end of WMC and the start of it being in BHP. And I remember going into a group where there was, like 8 of us. And I think all of them were ex-WMC people, and all of them had been there 15 plus years. Right? Like I don't think I've ever walked into a group now where you could get that level of kind of longevity in a company, right? But to your point, like we're talking about that learning curve kind of model. Like I think that was a great thing that they could allow people to get better, to like train them, but also just keep them for a long, long time in that sense, right?
And then that IP stays in the business.
Yeah, that's
because otherwise that learning curve, as we sort of discussed before, obviously there's, the physical and the data and all that, but the IP that sits up here is now gone over there, and it just stalls that whole process.
So one of the unusual aspects of that Western Mining system was the concept of the guilds. The geoscientists were in a guild. So I might be working as a mine geologist at a particular mine, or I might be working as an exploration geologist somewhere, but there was the idea that someone was looking at the whole group of geoscientists and actually making decisions like, we're going to send him to a mine for 2 years to get this experience, or they're going on study leave, or they're going to exploration. Mm-hmm. So the discipline was managed holistically. And, what we saw changing in the 90s with the rise of HR culture and direct sort of, management control, that was seen as anachronistic, archaic, and maybe a challenge to...
and a cost item. That was the real reason.
Yeah, and a challenge to sort of management authority. And so all that got dismantled. And I don't think in large organisations there's much discussion that goes on of, here's my org chart of the 300 geologists I have in this organisation, and this is how... we're going to, we think these are the talent, these are the ones we have to do it. It's very much individuals fighting their way through whatever silos that exist, whether it's at an operation or in an exploration group.
It's amazing because, there are other industries that try and do this, but what they do is just make your pay vest way down the track, and they try and lock you in. So the fact that Western Mining could do this without just, essentially holding your pay from you.
Yeah, that's right.
It's
and it's
really
also
remarkable.
to your comment, Ali, about like the IP. There's this great book, and I can't remember the author's name. It's called Where Good Ideas Come From. Right, and they in the book they talk about that if you look at kind of like the stream of innovation over the last 100 years, like it often develops with this, like one person has one piece of the puzzle and this other person has the other piece of the puzzle. What you need is that connectedness between those ideas to kind of come together and become something. So my like view on this is like, like the reason why I think organizations like WMC and like CRA was another one that were I think successful is because they had this, right, that they kept that IP kind of bouncing around and hitting each other in that same organization. Now I think we may have still the same number of geologists, but now they're spread out over 1,000 companies. Yeah. So I think that interconnectedness of ideas probably is not as efficient as it could be when it's in one organization and it's being managed, like the talent is being managed holistically in that sense. And so I think that's kind of the challenge of why like we sometimes struggle to kind of progress along with ideas in some way as well.
John, the last thing I want to hear from you, and you've touched on this earlier, but AI, machine learning, all these things are clearly the buzzword of the last 3 years now. Mm-hmm. I want to hear from you, given your sort of deep technical experience here, and you've spoken about it in the sense of big data and these sorts of things and search spaces, and we should be going to places that don't have the data. But what do you think will be the implications from this sort of wave of investment in AI specific to the mineral exploration field?
Look,
this shouldn't be the last thing we should have talked about. This should be the first thing we should have talked about.
Look, my opinion is extremely limited, will be the impact. And I say this both on the basis of empirical experience. We talked about the last 3 years. There have been people, very, very smart people, way ahead of the curve doing this over a decade ago, spent probably $100 million without any success, and not because they weren't very smart and not because they didn't have the best technology. So that's sort of the empirical experience. The conceptual reason is that I think the critical thing that we need to understand is what defines a big data environment, meaning big data as in a problem set that is amenable to AI. And in my opinion, where people get confused is they think it's a big data environment if the available data can be measured in the terabytes. But if that available data does not very well represent the parameter space of interest, I think you've got a problem, right?
Yeah.
Because our parameter space of interest, I think, is a poor data environment. So conceptually, I don't think AI can ever do very well at targeting in these poor data environments. In principle, what it should be able to do is help us learn in our data-rich environments and extract patterns from that. So in principle, I accept that as a possibility, but I have to say I haven't yet seen any good examples. Mm-hmm. And some of the companies I'm involved with have invested in some of this, and to be honest, we've been disappointed with the examples. But I'm not an AI specialist, so I don't know exactly why these things have not worked. But my just lived experience so far is I haven't seen anything that's added value.
And I think to the comment about like why I think it's somewhat struggled. I mean, John and I have talked about this a fair bit, where like we get approaches by people trying to come in and like apply a more AI machine learning approach. And I think one of the fundamental issues I think comes from is that like John said, in mineral exploration we're a very data poor environment. Like we collect data, but we collect it in select areas quite well, but we don't we rarely collect holistic data. The data resolutions are always quite different in different parts of what we are trying to solve. Unless it's a very small area, then like maybe someone flies a geophysics survey or something like that at the same resolution. So there's two kind of problems. One is that we're a data poor environment, and B, we we have this, I think, changing rate of false positives, right? Like once you have to have a certain level of testing to figure out whether the anomalies that you've identified are appropriate or not. And machine learning works really well when you have a large base rate of a training data set. Yeah, we don't always have that. We're always trying to build this as we kind of go along. But one of the fundamental reasons, and like I've been guilty of applying a lot of AI in mineral exploration with limited success. And one of the issues I think I find with it is that, like AI machine learning, I think mineral exploration will be really good at interrogating the data sets when we have them. But often the challenge in mineral exploration is identifying where you should go collect data sets. And I don't think that is a question that will be best answered by machine learning, unless we just accept that we're going to spend millions of dollars collecting data sets everywhere at a set resolution, like however we want to do it. Then I think, maybe we can take our intellectual insights of what's an anomaly and what's not an anomaly and model it into a ML model, and then you can go and look for that. But I don't think we're there yet, right? Like we just don't have the amount of data.
Look, I think the issue of data is an important one, and I've had a number of conversations, the government agencies who want to improve their prospectivity, and it's like, well, should we invest in all this AI? And you say, well, don't do that. Invest in getting your fundamental data, right? So, for example, if you're dealing with an area that doesn't have, say, something like 1 kilometre grid gravity, you can't do best practice targeting.
Correct.
So, to me, it's kind of sort of irrelevant whether you're developing your best AI to look at the magnetics and all the other data you have when you're missing a key data set. Yeah. So I have a very, very strong bias to saying if you've got an increment of capital that you want to invest in moving a problem forward, collect that data. And we started this conversation, Jonas. You asked me about my 4 rules, and I only really got to rule 2.
Yeah, I was just about to say number 3.
Rule 3 was collect your own primary data in the search space of interest. And to Ahmad's point that he was just articulating, working out what that search space of interest is also an intellectual process, and in fact a key value creating process. But once you've done that, go and collect your own primary data. And rule 4, of course, something we've touched on again and again, is learning from test those targets and learn from that. So I will any day of the week say, in most situations, you'd be better off investing in collecting a primary data. It has to be a primary data set that really helps you with what you're doing. Things like gravity are good because it goes to the fundamental architecture of the crust, which is always important. But just coming back to, I think an interesting analogy when we think about domains where AI, deep learning, all of these things can work and they aren't, is the comparison between weather forecasting over the last few decades and earthquake forecasting, right? So these are both very, very complex non-linear systems. Weather forecasting is a classic chaotic, the butterfly flaps its wings and, the typhoon in or the tornado in Texas, whatever. But we've actually got a lot better with weather forecasting. Weather forecasts are quite reasonable now. And that's through massive computing power and making all these models and doing all this. On the other hand, earthquake forecasting is still really poor. And we had a big earthquake in Christchurch going back a few years ago, devastating. It was on a fault that wasn't even recognised. It wasn't even in the model, right? So with weather forecasting, we now, through satellites and whatever, we have a pretty good characterisation of our system, i.e. the atmosphere and the ocean atmosphere or the land atmosphere interface. So we've got a pretty, and we'll get better, but we've got a pretty good model for it. When it comes to something like earthquake forecasting, we have a very poor model of the relevant search space, which is the rock mass underneath us. And then you think about mineral deposits, it's not just forecasting one earthquake, it's forecasting a bunch of earthquakes that happened 2.5 billion years ago, right?
And the time interaction and all these type of things. And so I think this is kind of the concept, I think machine learning solves computationally heavy tasks, that's where it's got to. We're not at a point now where the true artificial intelligence, we've created something that can kind of come in and solve that problem. And so the domains where it's really struggled is where you actually need that, the answer is in the intelligence of how you contextualize data and review it and do that. And humans are still, I think, far better at it, than any computer we have currently.
I just had one final question, reflecting on sort of what we've discussed today. Do you think there is really a case for a single asset exploration company?
That's a good question.
A greenfields exploration? No, I don't. But I think that pretty much you have to. I mean, one of the issues here relates to the quantum of capital that can be raised. And I don't know whether any of you guys have heard of Mike Etheridge. He was a big leader of our industry about 20 years ago. He wrote some pretty influential stuff. And he was the first guy to really sit down and try and provide some quantitative analysis around exploration. And he actually published a paper, I think it was about early 2000s, where he bemoaned the fact that when you looked at the dynamics of the industry, the typical IPO raise was $4 or $5 million, and that was pathetic. Of course, it's still about $4 or $5 million.
Correct.
Yeah.
And that $4 or $5 million is now worth about half as much as what it was.
That's right.
And
ASX costs have only gone up.
Yeah.
And all of these type of things, right?
And ASX costs, heritage costs, ground costs. So, the reality is that, companies, they float, they raise money. This is my project, right? And I suppose that's what the investors are investing in. But realistically, what you are always investing in is a team that hopefully will explore that project. And if that fails, if you're not, which it probably will, if you're not very lucky, it will then get the next project and the next project and the next project, right?
I think that's the perfect spot to leave the conversation. Thanks a lot for your time, John and Ahmad. This has been a fascinating conversation.
Pleasure.
Appreciate it.
Thanks a lot.
I love this stuff.
Cheers.
Alrighty. Thank you very much, Ahmed, Ali, and Jon Hronsky. That was a great chat.
And thank you to you too for you smashed it out.
No, I loved it. Learnt lots. And there's certainly, sometimes it's easy to forget all the heuristics and biases we have as investors and mining companies have. So that was a really interesting piece that I loved about that chat.
Absolutely fascinating. We've got a couple other people to thank.
Oh, I love thanking these people.
Access Mining Technology, MMS, we had in the show. We also had Greenlands in the show. Give them a buzz. VRIFY, SMEC Power Technology, DSI Underground, Silverstone, CRE Insurance, K-Drill, and use Spark.
Use it.
Get on to Spark.
Have a good weekend, Money Miners.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.